What if everything you know about money is a lie? The financial system isn't broken, it's rigged, and it's designed to keep you poor. Banks create money from debt. Your debt. That's how it really works. Inflation isn't an accident. It's a hidden tax that steals from you every single day. They don't teach you this in school. Wall Street doesn't want you to know. Central banks control everything. And the American dream, it's been dead for decades. This is the financial red pill. Watch this video to understand what they hide from you. If you want to escape the rat race, you need to see the trap first. Let's begin.
You are not the investor. You are the investment. Right now, as you're watching this, there's a game being played with your money, your retirement, your future, and you don't even know you're sitting at the table. Think about it. You buy, and the market crashes. You sell out of fear, and it rockets back up. You follow the analysts, the hot tips, the financial television experts, and somehow, you're always one step behind. You've asked yourself, am I just unlucky? But what if it's not luck? What if the game was rigged from the start, and you've been cast in a role you never auditioned for? This is the invisible game. Imagine walking into a casino where you can't see anyone else's cards. You don't know the rules. You're not even sure what game you're playing. But every month, you sit down and push your paycheck across the table anyway. And somehow, no matter what you do, the house keeps winning. Not sometimes, every time. Here's the thing they never teach you. The difference between those who build generational wealth and those who become exit liquidity for Wall Street comes down to understanding one brutal rule. This rule isn't in school. It's not in personal finance books. It's not shared by advisors who earn commissions on your trades. It's quietly understood by a small circle of players who control the flow of capital, and they count on you never figuring it out. You already feel it, don't you? That something isn't right. That no matter how hard you work or how carefully you invest, the finish line keeps moving. You're not imagining it. Stick with me until the end, because at the 12-minute mark, I'm going to reveal the only rule that actually matters. Once you understand it, you'll never look at your money the same way again. The question is, are you ready to see the game for what it really is? Now, before we go deeper, I need you to do something. If what I just said hit home, if you've ever bought at the top and watched it crash, if you followed expert advice and watched it blow up, drop a comment below. Tell me your story. Because YouTube doesn't care about truth, it cares about engagement. And every like, every comment, every share is a vote that says, show this to more people. The mainstream financial media won't tell you what I'm about to tell you. They're funded by the same institutions we're exposing. So if you want more of this, subscribe and hit the bell. This isn't about growing a channel. It's about building a community of people who refuse to be exit liquidity. All right, let's get back to the game, because understanding that you're in it is only the first step. The real question is, how does it actually work? What I'm about to tell you might sound extreme, but stay with me. Wall Street isn't a free market. It operates with the exact same structural logic as organized crime. I'm not being dramatic. I'm talking about the actual mechanics, the playbook. Once you see the parallels, you can't unsee them. Think about how organized crime works. It's about information asymmetry and control. The mob knows things before anyone else. They have people on the inside, cops, judges, politicians who look the other way. They launder dirty money through legitimate businesses. And when they get caught, the penalties are so light compared to the profits that it's just a cost of doing business. Sound familiar? Let's break it down. First, insider information. In the streets, it's called intelligence. On Wall Street, it's called privileged access. Executives know about mergers before they're announced. Hedge fund managers get earnings data before it's public. Sure, there are laws against insider trading, but enforcement is a joke. The SEC catches a few scapegoats, slaps them with fines that are a fraction of what they made, and the game continues. You're trading on yesterday's news. The smart money acted weeks ago. Second, price manipulation. Organized crime controls territory through force and intimidation. Wall Street manipulates prices through high-frequency trading, spoofing, pump-and-dump schemes, coordinated moves that create artificial momentum. They use media, analysts, influencers, even trading apps to herd the crowd in one direction while they're moving in another. Remember GameStop in 2021? Retail traders figured out the game for once. They saw hedge funds were massively short and they squeezed them. And what happened? The platform shut down buying. They changed the rules mid-game because the wrong people were winning. That's not a market. That's a rigged operation. Third, money laundering. The mob runs illegal profits through car washes and restaurants until the money looks clean. Wall Street does the same thing, just with better lawyers. Offshore accounts, shell corporations, derivatives so complex even regulators don't understand them. The 2008 crisis is the perfect example. Banks packaged toxic mortgages, lied about their quality, sold them to pension funds, bet against them on the side. And when everything collapsed, they walked away with billions while millions lost their homes. Not a single major executive went to prison. Not one. Let that phaser in. Fourth, regulatory capture. In organized crime, you corrupt the authorities. On Wall Street, it's called the revolving door. Regulators leave the SEC and take seven-figure jobs at the banks they were policing. Goldman Sachs executives become Treasury secretaries. The people writing the regulations are the same people who profit from the loopholes. It's not corruption in the traditional sense. It's legal corruption. The system working exactly as designed, just not for you. Here's a concrete example that ties it all together. The LIBOR scandal. LIBOR was the benchmark interest rate affecting trillions in loans, mortgages, derivatives, the foundation of global finance. And for years, the biggest banks in the world were rigging it, colluding, manipulating numbers to boost their profits and screw everyone else. When they got caught, they paid fines, billions in fines, but still a fraction of what they made. No executives went to prison. The banks are still operating. The system didn't change, just the cost of doing business. Here's the brutal truth, and this is the line that crystallizes everything. The difference between the mafia and Wall Street is that when you're dealing with the mob, you know they're criminals. On Wall Street, they wear tailored suits. They appear on CNBC with confident smiles. They use words like fiduciary duty and market efficiency. And somehow, we're supposed to believe they have our best interests at heart. They've built an entire mythology around the free market, around meritocracy. The idea that if you work hard and invest wisely, you'll be rewarded. But it's a lie. The game is designed to extract wealth from the many and concentrate it in the hands of the few. And the most brilliant part? They've convinced us that when we lose, it's our fault. We didn't diversify enough. We didn't do enough research. We panicked at the wrong time. It's never the system. It's always us. But once you see the structure, once you see the operation for what it is, everything changes. Your decisions change. Your relationship with money changes. If this is clicking right now, drop a comment. I see the game. We're just getting started. Here's where things get uncomfortable, because I'm about to show you the exact mechanics of how your money gets transferred to someone else's pocket. There's a term you need to know. Once you understand it, you'll see it everywhere. Exit liquidity. Sounds technical. It's brutally simple. You are the buyer who allows smart money to sell at the top. You are the cash that lets them exit with maximum profit. You're not investing. You're providing liquidity for someone else's exit strategy. This is a four-stage operation. It happens over and over in every market, with stunning predictability. And most retail investors get caught in the same trap every single time. Stage 1. Accumulation. Insiders are quietly buying. They're not on CNBC. They're not posting rockets on Twitter. They're loading up while prices are low, sentiment is negative, and nobody's paying attention. They know something you don't. Upcoming regulatory changes, a merger being negotiated behind closed doors, deep analysis that won't be public for months, whatever it is. They're accumulating while it's still cheap. Stage 2. Promotion. This is where hidden truth becomes manufactured narrative. Suddenly, everyone's talking about this stock, this sector, this asset class. Analysts upgrade ratings. Financial media runs segment after segment. Influencers post gains, charts with rockets, phrases like, "This is the future," and "You don't want to miss this." The goal? One thing: FOMO, fear of missing out. That fear makes you ignore your instincts, ignore valuation, ignore risk. You jump in because you're terrified of being left behind while everyone else gets rich. And here's the thing: the promotion isn't random. It's coordinated through aligned incentives. The fund that accumulated early wants prices up so they can sell. The analyst works for a bank that profits from trading volume. The media gets paid by advertisers who win when people trade more. The influencer earns affiliate commissions from trading platforms. Everyone benefits from getting you excited, getting you active, getting you to buy. Stage 3. Distribution. This is the beautiful part, from their perspective. As retail investors pile in, excited by gains, confident they've caught the wave, smart money is quietly exiting, selling their shares. To you, you're buying at prices they would never pay. You're operating on emotion and narrative. They're operating on math and timing. Every share you buy at the top is a share they're unloading with a smile. You think you're getting an opportunity. They know they're getting out with profit. You are, quite literally, their exit liquidity. Stage 4. Collapse. The hype fades. News cycle moves on. Influencers stop posting. Ratings get quietly downgraded. Price falls. At first, just a dip. Healthy consolidation. Buying opportunity. Then it keeps falling. And you're holding the bag. You bought high because everyone said it was going to the moon. Now you're watching your account bleed while smart money is already looking for the next setup, the next cycle, the next group of retail investors to provide liquidity for their exit. It's like selling ice to someone in the Arctic, except the ice was already melting when you bought it. And the person who sold it knew exactly how long until it turned to water. They timed it perfectly. You didn't even know you were on a clock. That's the game. That's the operation. Individual stocks, entire sectors, crypto, SPACs, whatever the hot trend is, the setup changes, the structure stays the same. And this isn't theoretical. Let me hit you with data that should make your blood boil. Study after study shows retail investors systematically underperform institutions. Not a small gap. Massive wealth transfer. Dalbar research tracking investor behavior over decades consistently shows the average investor earns returns far below market average. Not because the market isn't going up, because of timing. Retail buys high, sells low, with stunning regularity. Enters when everyone's excited, exits when panic hits. Institutions do the opposite. They provide shares when you're buying. They buy back when you're panic selling at a loss. Another study looked at brokerage data across millions of accounts. The more retail investors trade, the worse they perform. Most active traders had the worst returns. Why? Every trade is an opportunity to be on the wrong side of someone with better information, better tools, better timing. You think you're making smart decisions. They know you're reacting to narratives they helped create. It's not a level playing field. It's not even close. But here's what changes everything. Awareness. Once you see the cycle, once you understand how value gets extracted behind closed doors, you stop playing the game the way they expect. You stop chasing hype. Stop trusting the narrative. Start asking different questions. Start watching what smart money actually does, not what they say. That shift in mindset? That's when you stop being exit liquidity and start protecting yourself. If you've ever felt like you bought at the worst possible time, if you've ever wondered why your investments seem to go south right after you get in, drop a comment. I've been exit liquidity, because recognizing it is the first step to never letting it happen again. Now here's the part that should make you furious. Because once you understand how the extraction works, the next question is obvious. Why doesn't anyone go to prison? Why do these schemes keep happening, cycle after cycle, crisis after crisis, with the same players getting richer while everyone else suffers? The answer isn't that the system is broken. The system was designed exactly this way. Let me show you how the protection racket actually functions. At the center is something called the revolving door, and it's the key to understanding why white-collar crime at the highest levels is essentially legal. Here's how it works. Regulators at the SEC, the Federal Reserve, the Treasury, they spend a few years in government, supposedly protecting the public. policing Wall Street, enforcing laws. But everyone in those agencies knows that their real payday comes after they leave. They go straight to the banks, the hedge funds, the law firms representing financial institutions. We're not talking modest raises. We're talking government salaries of maybe $150,000 a year, jumping to multi-million-dollar compensation packages on Wall Street. So imagine you're a regulator. You're sitting across the table from Goldman Sachs investigating a potential violation. But you know that in 2 years, you want to work for them. You know that being too aggressive might hurt your future job prospects. You know the person you're investigating today might be interviewing you tomorrow. What do you think happens to enforcement in that environment? The incentives are completely backwards. The watchdogs are auditioning for jobs with the institutions they're supposed to be watching. It's regulatory capture at its finest. And it means the truly dangerous crimes, the ones affecting millions of people, almost never result in real consequences. When violations are too obvious to ignore, when public outrage gets too loud, what happens? Fines. Just fines. Banks pay a penalty that sounds massive in headlines. $2 billion, $5 billion, even $10 billion. Media reports it like justice was served. But here's the truth. Those fines are a tiny fraction of the profits from the illegal activity. It's a cost of doing business, a tax on crime. Shareholders take a small hit. Executives keep their bonuses. Nobody goes to jail. Most settlements include clauses saying the institution doesn't have to admit wrongdoing. They pay, issue a statement about moving forward, and continue operating exactly as before. Let me put this in perspective. If you walk into a convenience store and steal $500, you're going to jail. Arrested. Prosecuted. Convicted. Your life fundamentally altered. But if you're an executive who orchestrates a scheme defrauding investors out of $500 million or $5 billion, what happens? Your company pays a $50 million fine. You face no criminal charges. You keep your job. Keep your wealth. In a few years, you're sitting on another board, still embedded in the system. Your crime affects thousands, maybe millions of people. Retirement accounts wiped out, homes lost, families bankrupted. But you're fine. More than fine. You might get a golden parachute when you retire. This isn't the system failing. This is the system working exactly as designed. The people who write the laws, who fund political campaigns, who have access to lawmakers and regulators, they're the same people who benefit from this architecture. Wall Street spends hundreds of millions on lobbying every year. Funds campaigns on both sides. Make sure that no matter who's in power, their interests stay protected. When reform does happen, when there's enough public pressure after a crisis, those regulations get written with so many loopholes, so many exemptions, so much complexity that they end up largely performative. The Dodd-Frank Act, passed after 2008, was supposed to rein in Wall Street. What happened? Banks immediately lobbied to weaken it, delay implementation, carve out exceptions. The regulations that survived were so complicated only the biggest institutions could comply, making them more dominant, not less. Within years, significant portions were rolled back anyway. And here's the really dark part. This structure doesn't just protect criminals after the fact. It actively encourages future crime. When executives know the worst-case scenario is a fine paid by shareholders while they personally walk away wealthy, what incentive do they have to follow rules? When the expected value of breaking the law is massively positive, make $1 billion, risk $100 million fine, you're not deterring crime. You're pricing it. You're telling people exactly how much it costs to steal. And for the biggest players, that price is a bargain. But here's what matters now. Understanding this isn't about despair. It's about clarity. Because once you see how the game is rigged, you stop playing by their rules. You stop trusting narratives designed to make you exit liquidity. You start making decisions that protect your wealth instead of transferring it. The transformation that needs to happen isn't just societal. It starts with you, with what you do next, with how you invest, who you trust, and what questions you ask before putting your money anywhere. The system won't change overnight, but your relationship to it can change today. If this is making you angry, if you're realizing just how rigged the game really is, drop a comment. The system protects them, because acknowledging it is the first step toward demanding something different, and more importantly, toward protecting yourself while you do. Now let's get to what actually matters. Understanding the game is one thing. Knowing how to move differently within it is what creates real transformation. So here are the rules they don't teach you. The principles that shift your entire mentality from being a player in their game to being someone who operates outside their expected patterns. These aren't get-rich-quick schemes. These are fundamental truths about how smart money actually moves. Once you internalize them, your decisions will never be the same. Rule 1. Follow the money, not the mouth. Stop listening to what analysts say on television. Stop following hot stock tips on social media. Stop reading headlines designed to generate clicks and emotional reactions. Instead, learn to track what institutional investors are actually doing with their capital. There are tools and filings, 13F forms, insider transaction reports, institutional ownership data that show you where the real money is positioning itself. When a major hedge fund is quietly accumulating a position over months, that tells you something. When insiders at a company are buying shares with their own money, that tells you something. When institutions are exiting a sector that the media is still hyping, that tells you everything. The noise is designed to distract you. The smart money moves in silence. Learn to read those movements, and you're operating with a completely different level of awareness. Rule 2. Mass enthusiasm is a sell signal. This is contrarian thinking, and it's one of the hardest principles to execute because it requires you to resist the emotional pull of FOMO. But here's the truth. By the time everyone knows about an opportunity, by the time your coworker is talking about it, by the time it's trending on social media, the smart money has already positioned itself and is looking for an exit. That doesn't mean never buy what's popular. It means be ruthless in your analysis. Ask yourself, who's selling to me right now? Who benefits from me buying at this price? What's the logical endpoint of this trend? Warren Buffett's famous line is cliché because it's true. Be fearful when others are greedy, and greedy when others are fearful. The best opportunities often feel uncomfortable. They're in sectors everyone hates, assets that have been beaten down, situations where the narrative is overwhelmingly negative but fundamentals are quietly improving. That's where fortunes are made, not in chasing what's already run up. Rule 3. Before you take advice, trace the paycheck. This is critical. Most people never think about it. When an analyst on television tells you to buy a stock, who do they work for? Most analysts work for investment banks that make money on trading volume, on underwriting deals, on maintaining relationships with companies they cover. Their incentive is not to make you rich. Their incentive is to generate activity. When a financial advisor recommends a fund, how are they compensated? Many get paid based on products they sell, incentivized to recommend whatever pays the highest commission. When an influencer pumps a cryptocurrency or penny stock, what's their position? Are they trying to create exit liquidity for themselves? Following misaligned advice compounds over time, eroding your wealth slowly and systematically. But when you evaluate advice through the lens of incentives, you become almost impossible to manipulate. Rule 4. Asymmetry is everything. This might be the most important rule of all. Smart money doesn't take symmetrical bets where you risk $1 to make $1. They look for asymmetric opportunities. Risk a small defined amount, but the potential upside is massive. Option strategies, certain private investments, early-stage opportunities where you can afford to lose your entire investment, but a win returns 10 times or 100 times your capital. And it's not just about financial instruments, it's a mindset. Position yourself where downside is protected or limited, but upside is exponential. Most retail investors do the opposite. They take huge risks chasing marginal gains, or they play it so safe that inflation erodes their purchasing power. Here's the revelation. You don't need to win often if your wins are massive and your losses are contained. You just need to be in position when the asymmetric opportunity hits. Rule 5. You will never have the best information. Accept it. This isn't about giving up. It's about being realistic. By the time news reaches you, smart money has already acted on it. The market has already priced it in, at least partially. So what do you do with that truth? Stop trying to time the market based on news and narratives. Build positions over time. Focus on long-term fundamentals that won't be disrupted by short-term noise. Accept that you won't buy at the absolute bottom or sell at the absolute top, and that's okay. The goal isn't perfection. The goal is not being the last one in and the first one out, which is exactly what happens when you chase headlines and hype. And here's the overarching principle that ties everything together. It's not about beating Wall Street at their own game. You're not going to outtrade Goldman Sachs. You're not going to have better information than a hedge fund with teams of analysts and proprietary algorithms. That's not the point. The point is to stop playing the game the way they expect you to play it. Stop being predictable. Stop being emotional. Stop being the exit liquidity. Start thinking in terms of protection, asymmetry, and long-term positioning. Start operating with the awareness that the game is rigged, but that awareness itself is a form of power. If these rules are clicking, if you're starting to see how to move differently, write in the comments, "Playing a different game." Let me know this is resonating, because we're about to bring this all home. You now know the game exists. You understand how it's structured, how Wall Street operates like an organized operation, how retail investors get turned into exit liquidity through predictable cycles, how the architecture of impunity protects the players at the top while everyone else takes the losses. You've learned the rules they don't teach in school. So now comes the most important question. What are you going to do with this knowledge? Because awareness alone doesn't change your situation. Information without action is just entertainment. You can watch this video, nod along, feel that surge of understanding, maybe even get angry at how rigged everything is, and then go right back to making the same decisions you were making before. That's what most people do. They consume content that challenges their worldview, feel momentarily enlightened, and then the weight of habit pulls them right back into the same patterns. But I don't think that's you. If you've made it this far, you're ready for something different. So let me lay out the choice. Path 1. You continue being cash flow for the smart money. You keep chasing the hype, following the crowd, trusting narratives fed to you by people whose incentives are completely misaligned with yours. You keep buying at the top because everyone's talking about it, selling at the bottom because you're scared, thinking the reason you're not getting ahead is because you're not working hard enough, or you're not smart enough, or you just haven't found the right opportunity yet. And the system keeps extracting wealth from you, month after month, year after year, until you wake up at 65 and realize the retirement you were promised is a fraction of what you need. And the people who were supposed to help you build wealth were actually using you as liquidity for their own exits. Path 2. You decide to move differently. You start following the smart money instead of the noise. You develop contrarian instincts that let you question consensus before opportunities become obvious. You ruthlessly evaluate the incentives of everyone giving you advice. You seek asymmetric opportunities where downside is protected, but upside is exponential. You accept that you're operating with an informational disadvantage and build strategies that don't require perfect timing. You stop playing their game. You start playing a different one entirely. Let me be clear. This isn't about becoming some genius investor who beats the market every year. That's not realistic. That's not even the goal. This is about protection. This is about not being the sucker at the table. In a system designed to extract wealth from the many and concentrate it in the hands of the few, your first job is to not be extraction fodder. Real financial literacy, not the kind they teach in high school economics where they tell you to save 10% and diversify, but the deep understanding of how money and power actually flow through markets. That's not a luxury. That's self-defense. That's survival. The system was armed against you from the beginning, designed by people with capital, for people with capital. Everyone else just provides the liquidity that keeps the machine running. The education system doesn't teach you this. Your parents probably don't know it. Your financial advisor has every incentive not to tell you. So where does that leave you? Right here, at this exact moment, with a choice. Before this video, you were a piece being moved, a resource being extracted, cash flow keeping someone else's wealth machine running. After this video, you've seen behind the curtain. You know the hidden mechanisms, the real rules that govern how money moves and who ends up with it. That knowledge is power, but only if you use it. The impact of that choice compounds over time. Every decision you make with this new awareness, every time you resist the hype and think critically about who benefits from your actions, every time you position yourself asymmetrically instead of taking bets that favor the house, those decisions add up. They create a completely different financial trajectory, not overnight, not in some dramatic transformation, but steadily, methodically, in a way that actually builds real wealth instead of generating fees and commissions for everyone else. So I'll ask you one final time, are you going to keep being exit liquidity? Or are you going to start moving with intention, with strategy, with the awareness that changes everything? Drop a comment. I choose awareness. Because that choice right there is where your real financial journey begins. If you made it all the way here, that tells me something about you. You're not looking for quick fixes. You're not here for surface-level explanations. You're willing to sit with uncomfortable truths instead of just consuming whatever narrative makes you feel good. That's exactly who I make this content for. So if this shifted something in how you see markets, money, and power, subscribe. Because this is just one piece of a much bigger picture. Every week I'm breaking down how wealth actually moves, how systems of corruption function, how everyday people get turned into resources for those at the top. Today was the architecture. Next time, we go into the specific plays, the strategies, the real cases, the next layer that builds directly on what you just learned. Drop a comment. I made it through. I read everyone. And your engagement isn't just numbers. It's what tells YouTube to show this to more people who are still playing the game without knowing the rules. Hit the like button. Share this with someone who needs to hear it. Now click the video on screen. This isn't the kind of knowledge you absorb in one sitting. It's a journey. Stay on it with me. See you in the next one.